Good afternoon and welcome into Market Talk on this Friday, January 28th. Thank you so much for joining us, making us part of your day once again. I am your host, Jesse Allen. Again, good afternoon to you. Thanks for tuning in. You can find us online. MarketTalkAg.com is our home on the web. You can find all of our streaming sources there, whether you listen to us on Apple Podcasts, Spotify, Amazon, you name it. So many ways to listen to the show. You can watch the videos on YouTube as well. You can find all of our social media there, the latest news of agriculture, much more online, markettalkag.com. Well, the ag sector, it was green across the screen on Friday, led once again by this soy complex. We have plenty to discuss as we wrap up this week's trade. And with that, let's bring in our good friend Ted Seifried with Zaner Ag Hedge joining us this afternoon. Ted, great to have you back on, sir. What a wild week it has been in these markets.
Yeah, wow. What a wild last few weeks it's really been. I mean, soybeans have been what a rally, right? I mean, since December 1st, we're talking about almost a $3 rally. Actually, that's from the November lows, but from December 1st, what are we? $2.80 rally almost. Wow. Yeah, certainly South American weather is part of that, a big part of that, concerns over that. And it's great when we see export sales come in, especially, when China comes in, like we saw on Friday, and they buy old crop beans, but then we've also seen them coming in and buying new crop beans. That is signaling concern over that South American crop and really kind of adding justification and adding credence and really adding value to the idea that there's some damages being done down there and that this is a problem, right? So that's really good to see. Then also on Friday, you have Indonesia saying we're going to curb our exports by 20% because of our high price palm oil domestically. Well, I mean, Indonesia, their palm oil exports is like 35% of the global veg oil exports. So, that's a big thing too. I mean, if they continue to do that, that probably means a huge amount of business for us for our soybean oil. So that really kind of took the lead there as far as the strength on Friday. You've got everything kind of coming together here. And so soybeans have had a massive run. The question that everybody keeps asking me is when will that end for soybeans? And honestly, I'm not sure. We're kind of getting to price levels where I thought would cap us out on this rally, but it also doesn't feel like we're maybe done yet either. And I really think that question relies on what happens with the corn. I've been saying for a little while now, I think the ultimate story when we look back a few months from now is going to be the corn market. When we look at the South American weather, sure, it's a soybean problem, but I think it's going to be a corn problem too. You look at Argentina's crop, the USDA only lowered it, 500,000 metric tons, but the Rosario Grain Exchange the same day lowered it 8 million metric tons. So I think the losses down in Argentina are a lot worse than what the USDA is currently letting on. And let's say they're 5 million metric tons, 6 million metric tons. Southern Brazil, CONAB lowered them almost 5 million metric tons. I think while Argentina's gotten a little bit of relief, the Southern Brazil crop still having problems with heat. Maybe you have to lower that even more. But ultimately, the second season Seifried corn crop, that's something that I've been talking about for a little while. I'm concerned about that crop for two reasons. One, this is another La Nina year. It's what they call a double dip La Nina, where you have it 2 years in a row. Well, we know what happened with that second season Seifried corn crop last year with La Nina. They were expected to produce, 84 million metric tons. They came up with 60 million metric tons. Well, currently, the USDA is looking for that second season Brazilian corn crop to be 86 million metric tons. Okay, what if the weather isn't conducive for that? But not only that, with the high input costs for corn conversation that we're having about our acreage here in this country. Well, what about that second season corn crop in Brazil? That's not their bread and butter. That's the first season soybean crop. The second season corn crop, to some extent, is a bit of an afterthought for them. Are they going to want to risk really pushing that acreage in a situation with high input costs, in a situation where the weather forecast is scary? Maybe some of that acreage doesn't go in. And if the acreage does go in, are they going to want to really spend a lot of money on inputs going into that? So I think that Brazilian second season corn crop very likely will be quite a bit below what the USDA's current expectations are. And you put that together with problems in Argentina, problems in Paraguay, problems with the southern Brazil first season corn crop. And all of a sudden, you could be talking of a 18 to 22 million metric ton gap or hole in global production. And I'm not saying that all of that is going to come to us in the form of exports. But what if 5 or 6 million did? I feel like that's a fairly conservative estimate
Mhm.
in that sort of scenario. Well, 5 or 6 million metric tons of increased exports, by the way, some of that might be to Brazil, but 5 or 6 million metric tons of increased exports for us put our balance sheet down to somewhere between 1.1 and 1.3 billion bushel carryover, kind of depending on what happens with ethanol. But at let's say we're at a 1.265. That's exactly where we were for old crop. But our stocks to usage would be tighter this time around because our demand's higher, which put us in a situation where we might have to start price rationing corn, saying, hey, we can't afford to have more than about 6 million metric tons of exports increased from where the USDA's current projections are. And if that happens, then we're price rationing into a scenario where we already have an acreage battle brewing, and not just corn versus soybeans. It's corn versus soybeans versus every other thing that you can put in the ground is making money right now. So
Mhm.
everything is going to be fighting for acres coming into spring. And do all of this on top of an inflationary scenario where we've seen it in the used car market, we've seen it in luxury items like watches, but we see it in beef prices, we see it really everywhere. Consumers are willing to absorb higher prices, and therefore producers are willing to absorb higher prices for input costs because they know they can pass that along to the consumer. So we have a scenario where price rationing doesn't happen easily. It's probably going to happen at higher prices, higher than what we would really imagine it should. So the powder keg is sitting there. Do we have a spark to make it, really explode? And again, I think the powder keg for soybeans has already happened. For corn, I think we're sitting on that right now. And with what we did on Friday and that close over 633 in the March corn, I think that powder keg is getting lit right here. I think we are on some very interesting markets. Now, that being said, I want to stress this, right? We are at some very good prices. 4 times in history have we been at or above these prices. And also, really only once before in history have we been at these prices at this time of year. In my mind, it is crucial to go and make some cash sales, probably more aggressively, quite a bit more aggressively than you would normally at this time of year, because we are at some really very good prices. And if you are paying high input costs for corn, you really can't risk a $2 slide if that were to happen based on some black swan event happening macroeconomically, phytosanitary, or just we end up having a really fantastic crop in a climate of the Fed aggressively raising rates. There's a lot of things that can happen to make prices quite a bit lower by the time we get to harvest. So you do have to really manage your risk, but also keep an idea out there that prices could get really, really, we can go quite a bit higher in corn, I think. So again, make your cash sales, but feel free to come in and re-own the board using call options, call spreads, things like that. I'm not as aggressively suggesting that in soybeans anymore because we've already had a big bulk of what I think the move would be in soybeans, but maybe you do some of that too. But for corn, right? I mean, that's the one that I see over the course of the next 3 months is maybe having the most upside potential.
Well, you hit it the nail on the head there, making some cash sales. If you want to come back in, re-own it on paper, you can lock floors in. You have a lot of options here. Today, beans, bean oil, canola, palm oil, all making contract highs. I think corn was right there as well, Ted, if I remember on
Just
the
missed it.
close.
Yeah,
Yeah.
so the contract high for March is 640 and a half.
Yep.
We had a previous high of 633. We had to get over that 633.
Mhm.
Now we got to get over 640 and a half. But I think we'll have a much easier time, I think, getting over 640 and a half than the 633. Now I think it's fairly clear sailing for the corn as long as you don't have, again, a black swan event, something major change in the overall weather pattern
Mhm.
in South America. We'll see. But corn, this was a major hurdle to get over. We did it on Friday with where we closed. I think it looks good right now.
Well, on top of all of this, I know you like to talk about crude oil, and we got to talk about this crude oil market. I mean, at one point Friday, $89 a barrel. I know looking at it right now as we talk, 86, just under
Mhm.
87. Talk about this crude oil market, the surging oil market, and how that's all playing into the ag commodities right now.
Yeah, absolutely. I mean, certainly it touches grains from an energy's point of view, both soybean oil and corn for ethanol. Uh, and it's going to be a factor in the markets. But I will say this, everybody's been talking about $100 crude oil, and I think we'll get there, or at least get very close to it. I mean, maybe we'll get like 99.75 or something like that. But either way, I think we'll get there. That being said, the price action that we've seen the last 2 days in crude, uh, pushing into new contract highs and then sort of falling flat on the day or even slightly lower on the day, it's kind of saying that maybe we're setting up for a bit of a correction in crude oil. Um, it might be just one of those things to kind of scare out the week longs and maybe put some fear into the market that, oh, maybe we're not going to 100, maybe that was it, whatever. Ultimately, I think that will be a nice buying opportunity to kind of hedge our energy needs if we haven't already. Hopefully we have done a fair amount of that already. But probably be just a buying opportunity for the crude oil market. um, Part of that is we put in a pretty significant premium because of the Ukrainian Russian situation. Russia is a huge exporter of crude oil. Well, what happens if something disrupts that, or there's some sanctions put in place? Does that mean more export business for us? So there's a whole lot of what ifs there. But like, we could mirror this, when we're talking about the wheat. But when you have a potential situation like this, right? Russia invading the Ukraine, and what that would cause for grain exports, or in particular wheat and corn exports, but also crude oil exports. Well, the market gets really worried about that at first, but the longer we drag that on and nothing does happen, it doesn't necessarily mean the situation is de-escalating. From my point of view, I don't think it is, but the longer we go without something to happen, the more jaded we kind of get to it, right? And we just start taking some of that premium back out of the market. Whether we should or shouldn't be, we do that. And so I kind of feel like that's what was happening there for the crude oil market at the end of the week. It still remains to be seen what's going to happen in the Ukraine, what Russia's going to do, what our response would be if Russia does invade. So many question marks there. But like I said, we kind of get jaded to news as time goes by. And again, that could potentially create a little bit of a corrective move here in the crude oil in the shorter term.
Well, and to that point as well on the wheat market, I think
Yeah.
that's some of what we saw Wednesday, Thursday. We come
Right.
back in here today, and I think the wheat markets just kind of had to go along with quarter beans on the session, possibly. But talk to
Yeah.
me about the wheat markets and your thoughts with how that's looking here with all the geopolitical issues, et cetera.
Yeah, so much. I mean, there's always wheat's always a global market because it's produced in so many countries and there's exported from so many countries. Uh, but then you throw all this other stuff into it, and wow, it's a very complex market. And I'm gonna say this, Jesse, with all the things that I know about the wheat market, because again, there's so much, but all the things that I know about the wheat market, I feel like wheat is fairly accurately priced for the moment. I'm not as bullish on wheat as I was 2 or 3 months ago because I think a lot of those bullish factors have sort of faded. You do still have poor conditions for our winter wheat crop, but you also have 1 million acres more than what we had thought. So that goes a little bit of a way to offsetting that. And also, we've seen very poorly rated crops produce fairly well in wheat before. So that's always taken with a bit of a grain of salt. Like you said, and like I was talking about, I do feel like the Ukrainian Russian situation, while it may not be over, as time goes by, we kind of take some of that premium back out of the market. And then one of the big highlights for wheat midweek was the Fed's decision, leaving things unchanged. However, the wording that they're talking about, humble and nimble, suggesting that our fears, some people's fears of, 4 rate hikes this calendar year could be justified, and that it could even be more. Or honestly, Jesse, it doesn't matter how many times they raise the rate. It's what percentage. Like, what if we start sprinkling in some half point moves instead of these quarter point moves? Um, and so the dollar was sharply higher midweek. The range that we had in one day of the dollar, I believe it was on Wednesday, or I'm sorry, Thursday, was the size of the range that we had basically through the months of November and December. So a big move to the upside in the dollar into new highs. That's obviously going to weigh on our wheat market, commodities as a whole, but wheat in particular, because again, all of that global export competition. So yeah, wheat had a rough week there on Friday. Started to come back a little bit. Maybe some short seller profit taking, but yeah, kind of going along with the row crops and the amount of strength that we had there. And I was glad to see that on Friday because I think that allowed corn to do what it needed to do and get up and over that key resistance level, that 633 we were talking about in the March corn. So going forward, wheat, I believe, is more of a follower. Again, it's going to be very sensitive to what happens to the US dollar, but I believe wheat is more of a follower to corn and to soybeans. I don't see any big fundamentals in wheat that make me feel like there's gotta be this big move coming that is independent from the row crops. Again, I think it's fairly accurately priced for now, but it would like to follow row crops, I would think, if the row crops continue to go higher, corn in particular.
How about over in livestock, Ted? That
Yep.
hog market started strong today. It looked like it was maybe putting a reversal in, then it came back and finished up a little bit. Cattle, we've been trying to fill chart gaps there, and cattle had a nice day today. What do you see in hogs and cattle here as we wrap up this week?
Well, let's start with feeder cattle. I mean, any day you got corn up, 10, 11 cents on the close on a Friday, and you got feeder cattle higher too, that's a pretty big win for the cattle, right? Um, and even, go back earlier in the week when you had commodities as a whole, a lot of commodities under a pretty significant amount of pressure because of that sharply higher dollar that we talked about. Cattle were not really down a whole lot, and that came from a day where we had a pretty significant amount of strength the day before. So, holding on to the gains. Uh, so the price action in cattle feels pretty positive to me at this point. I think our domestic demand is going to stay really very strong. Packer margins are good. We have room, I think, to pay higher, to see higher cash trade. Whether that happens or not, I don't know. But I can fundamentally justify $1.50 fat cattle. Um, in fact, I think that's kind of where we should be given the climate that we're in. But again, cash is going to have to continue to go higher. I think there's room for it to happen. That remains to be seen. As far as the hogs are concerned, you look at the April hog contract, and what we did basically from the middle of January to now, just a very short time frame, a little over 10 days. We've traversed from just above 83 to just below 98, almost a $15 move in a very short period of time. We were due for some corrective activity, very overbought. And that sharply higher dollar, albeit happening in the same day where we saw a really, really supportive export number for hogs, for pork, um, that sharply higher dollar, I think, was the catalyst and the trigger for us to have that sort of corrective action. And then on Friday, like you said, you had the good, the bad. We were on both sides of unchanged, but closing a little bit more positive on the day. I like that. We did not follow through to the end, to the downside. We held our short-term moving average support. I still think there's more upside potential in the hogs. I think what we're seeing right now is sort of a sideways corrective pattern, sort of a breather area before we try, at least attempt to take that next leg higher. I'm optimistic that'll work out, but again, we took off. We really took off in the month of January for hogs. As fundamentally, I thought we were really undervalued in hogs. Now I think we're closer to fair value. So it's a market that needs to be watched closely, especially from a producer perspective, especially after the gains that we just saw. But I'm optimistic that there's more upside potential here for the hogs.
Well, Ted, you covered a lot very eloquently as always. Any final thoughts you have for us here on this Friday?
I'm going to bring it back around to what we were talking about. With prices where they are right now, even basis where it is right now, it's great to be optimistic that things are going to continue to go higher. It's great to be bullish on the market, but you have to be cognizant of your risk management. You have to understand that history says we are not up here very long, whether it's price rationing of demand or increasing supply dramatically, both domestically and globally, or if it's a big change in the overall economic climate. There's almost always a reason why these prices don't stick around very long. So I'm bullish corn in particular. But that doesn't mean I'm not really recommending making some fairly aggressive cash sales right now. There are re-ownership strategies that we can use that offer a whole lot less risk if there were to be a turnaround in this market. You got to be vigilant. You got to be active on making those cash sales. We have a whole lot of profitability in front of us don't give the market a chance to take that away from you.
Well, Ted, I know if folks need advice, they could reach out to you there at Zaner and get a little bit of that advice, can't they?
Yeah, absolutely. You can reach me directly at, well, you can find us on the web at www.zaner, that's Zaner. But you can call me directly. I'm pretty much always around. 312-277-0113. Aside from that, if Twitter's your thing, you can find me on Twitter. I'm at the Ted Spread.
Well, Ted, we appreciate the time as always, sir. Thanks for joining us. We'll talk to you again soon. Have a great weekend.
Thanks, Jesse. You do the same, buddy. Always a pleasure to talk to you.
Ted Seifried with Zaner Ag Hedge joining us here on Market Talk. That's going to do it for the Friday, January 28th edition of the show. Find us, markettalkag.com. I'm Jesse Allen. Have a great afternoon.